Hello, investor. Mike Chupka here from PowerOptions with just a quick little video. We had a coaching session this morning with Maurice about rolling a deep, in-the-money covered call right at expiration, expiring today on the 18th. Now, I'm in a similar situation that happens to the best of us. So let's take a look at some of the opportunities, decision process, and an alternative that I am considering using. For our example, we'll take my position. Let's say that I own shares of stock, Kraft Heinz at $31.50. I sold the 18th of December $33.50 call at 91 cents. Hey, it's a great position to be in. I get assigned today, make 9.5% or roughly $291. The stock hit close to $35.50 today during trading. The option's 5.6% in the money. Buyback cost is about $210, a little bit more than double of what I initially collected. Now, it's a great situation to be in, as I mentioned. Maurice is in a similar position, but he's holding a 40-strike call with a much higher return on a different stock, but it's trading at 55, and it keeps moving up. The buyback cost of that option is $15 plus to roll, pretty much over a third of what he already has invested in the position. Well, how would we potentially evaluate opportunities? Well, the first steps, of course, is I'm tracking my covered call in the portfolio tools. I'm going to use the More Information button to go to Position Actions and then Position Analysis. This gives me a current breakdown of my position, my original position value, my current liquidation value if I bought to close the call and sold to close the stock today, and of course, my expiration value if I just let the position be assigned. There's that 290 or roughly 9.5% on the position. Now the real power of this page, however, as I scroll down, it shows me rollout opportunities where all the math is done for me. But I need to evaluate, what is my current return? Well, we know we're at about a 9.5% on the Kraft Heinz covered call. I know my buyback cost is going to be about $1.50 or $2 if it was up at $35.50. What is the new premium I can receive for the potential rollouts listed below? And am I able to roll for a credit, which would show up as a negative adjusted net credit, or am I rolling for a credit or rolling for a debit, which would appear as a negative value in the adjusted net credit field for the rollouts? Does this increase my return by my goals? In other words, if I'm extending the position out another 13 or 21 days, and I'm gaining 1% for 21 days or 1% for 13 days, does that match my trading plan? I don't want to roll for the sake of rolling. It has to match my trading plan. And what is my expectation? Is it worth increasing the cost basis now that I'm deep in the money to roll up to a new strike for a potential higher return if I fear the market is going to pull back and potentially I could go into a loss? Well, this is what the tool helps you evaluate. Maurice's position is a little bit more difficult. With the stock up now, his buyback cost on the option is about $15 to $17 as the stock continues to fluctuate. Most of the rolls that he sees are rolling for a debit, meaning he may be increasing his cost basis on the position $9, $8, $10, or even higher. He would increase the potential return moving up to the higher strike prices. But did those returns match his goals for the trading plan? Is it worth it to increase the cost basis of this position by $9, $10, maybe $12, hoping for that higher expected return if he is in fact concerned that this run is over and the stock might pull back? Let's pause for a minute and break down the choices. We're in the money, a couple hours to expiration. What can we do? Well, let the position be assigned. We're out of the trade. We've hit our targeted max profit for the position, and then on Monday, we can use the patented search tools on PowerOptions to find a new covered call that matches our criteria and our trading goals. If I really like the stock, I could buy back the stock and then look to sell a new call on Monday. Of course, I could buy to close or just roll the leg now. Buy to close the call, leaving the stock open with increased cost. We're probably not going to do that. Or rolling the leg and deciding to stay in after the analysis. Again, the drawbacks of rolling with this deep in the money means we're going to increase our cost basis into the position. We could potentially see a loss if a volatile stock now pulls backwards in the next 20 to 30 days below our new cost basis. In this case, rolling the call if you decide to stay in the position, because we're so close to intrinsic value to buy back the call, the math is essentially the same as taking assignment and then buying it back on Monday. We here at PowerOptions always suggest that if you want to stay in the position, you're still bullish on the stock, we're at expiration, just roll the call rather than taking assignment and then buying it back on Monday or doing a new covered call on Monday. The math is almost the same because we're increasing the cost by the intrinsic value. The stock's the same price on Monday. We will have the same increased cost basis. Is there another alternative? Well, there are many alternatives. Options give us options. But is there a way to avoid putting in the high buyback cost for the call while still potentially getting premium on the position? Where are we? We missed the run. We maybe didn't roll the call at the right time. The stock just got away from us. It's had this long run. We feel it might pull back, so we're concerned about adding too much to the cost basis to increase potential risk in the case of a pullback. We still might be neutral to bullish long term. So rather than roll and maybe add the cost right now, how about the alternative of taking assignment? In the craft position, I let it get assigned at $33.50. I pocket roughly $2.90 in profit or $2.91. The stock's bouncing around 35, so on Monday, maybe I sell a put option, a naked put or cash secured position at a lower strike, maybe the 34, maybe the 33.50 again. Now, if the stock does pull back, I may get assigned on my short put strike at the 34 or 33.50 strike, but I keep the premium, so I may have a lower cost basis on the position. Since an out-of-the-money naked put is essentially a parity trade to an in-the-money covered call, isn't this the same as if I rolled my covered call to that same expiration and the 34 strike or the 33.50 strike, as opposed to taking assignment and simply selling the put? Here's the simulation, the before and after picture of my current craft position on the left in red, the return today of 9.5%, $291 in profit if I allow it to be assigned. If I rolled to the 8th of January 34 call, shown on the right in blue, I'm going to increase my potential return from 9.5% to 10.9% potentially at January expiration if the stock is trading above $34. Well, that's a 1.4% increase in return, which sounds great, but it's for 21 days. Does that match my trading plan for this strategy in my portfolio and for my expectations of the underlying stock? Well, how does that compare? Increasing the max profit from $291 to $334, or 9.5% to 10.9% in 21 days, how does this monetarily compare to taking assignment and selling the put? What happens if I take assignment today? I do nothing. I don't buy to close the call. I leave it open. Well, I'll get a profit of $291 on the position. Then on Monday, I'll look to sell the January 34 put for 42 to 45 cents, perhaps. That total profit now on this position going forward is still 335. Monetarily, it's very similar to buying back the covered call, rolling it up to the 8th of January 34 call. We have a very similar break even, 30.66 versus with using the put, 30.65. Although I have to put up potentially the $3,400 to cover the margin requirement of the naked put, I haven't technically increased my cost basis yet. I didn't have to buy to close that call out of pocket. I'm going to get the return and then use that to cover the margin requirement on the position after taking assignment on the stock with the covered call. Taking the 44 cents for the 34 put, adding in the profit of 291 gives us a similar yield, maximum profit 335 or 10.9%. It's very similar to just rolling the covered call. For the KHC position, we do not see a big difference. Yeah, it cost me $1.50 or $2 to buy to close the call. That's out of pocket. Then I get a new premium at the higher strike. But in Maurice's case, he was looking at $15, $17, $18 on upwards of 600 shares of stock to buy it back now. It's a large amount of money to pay to roll the position and get $2 or $3 back. Rather than getting assigned or trying to buy back the stock at 55 or 57, meaning take assignment now and then on Monday going in and buying the stock, and here it's up at 58 as the trading day went on, he's expecting a pullback on the position. So why necessarily put the more money in now? Why not take the profit we were looking for and consider selling the 50 strike put? We still have a positive return if the put expires worthless, similar to rolling the covered call, but we haven't yet put out that full $17 or $18 to buy to close the call out of pocket. It's a potential lower cost basis. If the pullback does happen and his stock is below $50, well, he's got to buy now 100 shares of stock for $50. But he pocketed the initial profit of $6.60 from the covered call and taking assignment, and gets the additional $2.10 from selling the out-of-the-money naked put in this scenario. Puts the return up to a reasonable level above where he is right now. Yes, very similar to rolling the covered call, but he didn't have to put the $18 out of pocket right now to buy to close that initial call and then sell to open the higher strike where he's rolling at a debit. And if he's expecting a pullback, rather than increasing the cost by that amount, he takes the profit, sells a put, and his increased cost won't be incurred unless the stock's trading below 50 on January 15th expiration. Final quick thoughts on taking assignment on your deep in the money covered call and then selling it out of the money put to potentially get back into the stock. Yes, it has the similar risk reward to rolling the covered call right now, but we have the advantage of avoiding the upfront costs to buy to close our call on the position, though we will have to put up margin to cover the cash secured value. We can potentially get back into the stock at a lower cost basis if the pullback does happen as expected. And if it doesn't, the put expires, we keep that new premium, and you could consider selling a new put for the next expiration cycle. A risk with this, of course, is that we have to wait for assignment on the position today after hours and then look to sell the put on Monday. Stock price could be different. It could be lower, could be higher. We could lose a day or two of time value. That is important as well. This may not be the best alternative approach for your situation, but it is an alternative approach that you can use. Track your positions in the PowerOptions portfolio tools to analyze the current gain or loss. Evaluate the rollout opportunities to determine the new return, the new increased cost basis, and if it matches your goals for the strategy in your portfolio and your trading plan. Calculate assignment on the CC, what would your true profit be? And what would it be taking the assignment and potentially selling an out of the money put? Just another way to potentially manage your positions if you want to avoid the high buyback cost on a deep in the money covered call that just got away from you.